welcome to the program. I want to welcome my friends and colleagues, Jonathan Blotmacher and Robert Keebler. We're going to talk about more than actually just this topic, but there was just a very recent proposal by, I keep thinking Van Halen, but strengthen Social Security by taxing dynastic wealth. And
Van Hollen.
I know, I'm thinking of the band. Anyhow, this is, I believe, highly unlikely to get enacted. And I assume, Jonathan and Bob, you don't think there's a chance of this going through right now. Can't. But I think the implications and what this means for planning are significant. And as we were beginning, and let me just make a quick statement. We're going to have the PowerPoint, and we may have some other materials, including the actual proposal, available to you on the taskbar. Just click on handouts and you should be able to download them. I'm going to post a recording of this to Schenkman Education along with the materials. Peak Trust Company and Interactive Legal will also post copies of the materials and the recording to their websites. We don't give CLE or CPE, but you will get a certificate of attendance. And if you have any questions, instead of posting them through the question tab on the console, email Jonathan, Bob, or I. Our emails are at the end of the PowerPoint. So let me start with just a quick question or comment. And Bob, when we were preparing, we were starting to identify that this is not an isolated proposal. Why don't you tell us what this proposal, who proposed it, and tell us about things going on really all over the country in terms of increases in estate and even income tax. And I recently saw, but I don't have the material handy, some proposed property transfer and related real estate transfer taxes that have been increased in different places. But we're not going to get into that. But just from an income, wealth, and estate tax, maybe you and Jonathan can comment what's going on around the country in addition to this bill.
Sure, glad to do that, Marty. This bill is sponsored by Senator Van Hollen from Maryland, and at the same time, Senator Warren introduced a bill in the U.S. Senate, a wealth tax. But the interesting thing about that is the cutoff is 50 million. We haven't seen a cutoff that low before, so it's showing a trend. Your mayor, Marty, Mayor Mandami, is proposing that the new state of New York take the estate tax exemption down to $750,000 with a pretty substantial tax rate. The state of Washington just passed a very onerous wealth tax. California's
hang on. Let's say the rate for Washington, because it's a shocker to me. 30%.
30% rate. So I mean, that's on top of any federal tax. So now California also is proposing a wealth tax that has to go in front of the electorate. And then Virginia just increased their income tax to close to a 10% rate. So the trend is what's interesting. Forget the details. The trend is what's interesting. And the arguments from our friends on the left are that things are out of balance, and there's plenty of economic data that would support that thesis. Now, I'm not sure what most of our viewers today think. It's really irrelevant what we think politically. What's important is we understand that some of this is a harbinger of where the ball is going, if you will. And that's what we have to really focus on.
So, Jonathan, I don't think there's any chance of federal legislation getting signed by Trump while he's in office. But if we have a flip to Democrat control in the next presidential election, what do you think the odds are that something like this may very well get through?
Well, that of course depends, Marty, on the outcome of also the congressional races.
Right.
Because remember, a tax bill has to begin in the Senate. That's one of the requirements. And we'd have to see whether or not, there's backbone enough in the House and in the Senate to get it passed. The president would do it. Now, I agree with Marty. I think because of Trump signing a bill to substantially increase taxes is very low, but it all depends upon what else is being traded. I mean, we know right now that there is a war going on and it's got to be funded somehow. And that's a factor that has to be taken into account. But Marty, let me point out, Bob made a mistake when he talked about your mayor. You do not live in New York City, so Mayor Mamdani has no impact on you or me because we live outside of the city. And what surprised me about his proposal, which was to reduce basically the New York estate tax exemption from $7.5 million down to 750,000. Well, that proposal would reduce the amount of exemption available to people who are residents of New York, not just those who are residents of the city, and any increase in revenue attributable to that reduction in exemption would not directly affect the city at all. 100% the estate tax goes to the state of New York, not it goes to the city. Now, I don't know whether Mamdani's intention was to say, here's a way to raise money in the state and give some of that to the city, or whether he really just didn't understand. But
no, I think he understands that.
That's not going to go through. In fact, many years ago, Marty, when you and Bob were still diapers, there was a proposal to have a New York estate tax. It passed momentarily, and then it was retroactively repealed. I don't think there's any chance that that's going to go through, but I think it was probably a political statement by Mamdani rather than a serious proposal. But, you would drive an awful lot of people in New York State by substantially increasing the estate tax. At least that's my guess.
I'll venture another slightly different possibility. And I preface this by saying I have no awareness or sensitivity to the political nuances, just a thought. But I don't think anything that Mamdani does is not well thought out. He's a very shrewd politician and a man. And it may very well be, he knows that he can't, as a mayor of a city, change the tax system for the state of New York. But as the mayor of the city and an important figurehead for a portion of the Democratic Party, he may well be saying to Kathy Hochul, the governor of New York, you need to lower the exemption. I don't think 750 will ever happen, but they could lower the exemption, which presently is over 7 million, to a much lower number. Certainly they could settle on the 3.5 million that's in the proposal from Van Hollen that we're going to talk about. But the portion of that may well come back to New York to fund free childcare, free busing, and rental relief, which are cornerstones of some of the things that the mayor ran on. And if Kathy Hochul feels that Mamdani's endorsement and help in her reelection is important, perhaps this is something that could change in New York. And it wouldn't be untoward because, just like Bob explained a minute ago, the billionaire tax, which I don't believe has passed and may not pass in California, but certainly was proposed, the insignificant increase in Washington estate tax, and I'm sure there's others around the country. I think that the key point is this is a statement of where many people in the country want the tax system to move. It's the opposite direction of what the OBA recently enacted under Trump's presidency did in terms of making higher exemptions and huge tax breaks for investments and everything else. This is the opposite. And Jonathan, I feel like these proposals are similar to what we all, you, I, and Bob lectured on in 2020 and 2021, And it was almost like, hey, you know, you better move fast, because if you don't move fast, you could lose out. I think part of the difference is we're pretty confident, and I think everyone is, that this is not going to get enacted yet, but I think we need to have our fingers on the pulse of it. But I think it's, if you will, a warm shot that we need to take action and clients to act. And let me make a bold statement, and then you can shoot it down and beat me up, Jim. But I think that the messaging we as an estate planning profession are giving to our clients needs to change. I think the calculus of what clients need to weigh needs to change. The answers are going to be what the client decides. It shouldn't be what we decide. We should guide the clients, but they should make a decision weighing the relative risks. So what do I mean? On one side of the scale, we have some significant issues. You transfer significant wealth to a trust, can you get access to it? We have issues that, oh my, if we do like non-reciprocal SPATs, which is a very common planning for married couples, do we have a reciprocal trust doctrine risk? If we do non-reciprocal SPATs, what matrimonial risk is there if the couple divorces? Those are risks. But another risk, which this is highlighting, and nobody has, without a crystal ball, nobody can weigh these risks, not only a crystal ball for the country, but for the family's future. But on the other hand, if we end up with, and we're going to talk about it in more detail, everyone, a $3.5 million estate exemption instead of 15 million, and that 3.5 million is not inflation adjusted, so in 10 years, it ain't going to be much, and $1 million gift exemption, which is proposed, and we have to talk about that because there's some lack of clarity of what that means to the DeSue and Bob and Jonathan. You know, we'll all talk about that. But on the other hand of the scales is, oh my, you know, my wealth could be decimated with a $1 million gift exemption and a $3.5 million estate tax exemption. If this legislation goes through, maybe what I should be doing is starting to plan now, just like we talked about in 2020 and 2021, and start shifting wealth, because we don't know what the future holds. Yes, you still have reciprocal trust doctrine. You still have divorce issues. You still have the critical need for access. But there's some differences now, I believe, in 2026 versus what we lectured on in 2020 and 2021. First of all, I don't even know, Jonathan, what year did you write your SPAT article?
Did I write my what?
SPAT, the Special Power of Appointment Trust article. When did you first start talking?
It was 2000. It was 2019. There's an article in Estate Planning magazine by Abby O'Connor, who's a practitioner in the state of Alaska. I think she's also admitted in Florida. Mitchell Gans, professor at Hofstra Law School, and me, which appeared there, called Special Power of Appointment Trust, which I thought was even better than what I had originally proposed in the United States, which was self-set trust. That one of the reasons that I'm going to emphasize that is that you really don't have to worry about reciprocal trust doctrine, because the grantor can never, ever become a beneficiary of the trust. So if I get a trust for my wife, created trust for me, she would be for the kids, but there would be 3 people outside of the beneficiary other than me who would have the power to force, who would have a special power of appointment in a non-fiduciary capacity to appoint assets from that trust I created to any dividend of either mother or my spouse's mother. And that would appear, if you take a look at the commentary 505 of the Uniform Trust, that does not submit the assets to claims of the grantor's creditors. It's a very big deal. And, you know, I can say that I think that's better because I think I take credit or blame for proposing the first asset protection trust legislation in the United States. But this is better because you don't have to worry about reciprocal trust doctrines.
So let me take what Jonathan said and propose a different type of question to pose to clients. Yes, there's reciprocal trust doctrine risk. There's risks of not having enough access to your assets, especially if we drop down to where now planning is important for clients at a much lower wealth level. You certainly have the issues and risks of divorce. But on the other hand, if you wait, your assets remain exposed to creditors, but also to this what seems to be a trend shifting towards much harsher estate tax that may or may not happen, but it's certainly a material risk. The clients have to weigh the risk, but the weighing of that risk is different than it used to be 10 years ago. How so? More than 10 years ago, I don't think many people were doing anything equivalent to a hybrid DAPT or a SPAT that Jonathan just described. Just last year, we had a very positive, at least I view it as very positive, case in Delaware, the title is something like CES 2007 Trust that upheld a DAPT, a self-settled trust. There was recently a case, maybe one of you remember the name, that just came out in Nevada, where Nevada DAPT was overturned, but it was not just a bad fact case, it was a horrible fact case. But we do have, where you take reasonable steps, more support now than we did years ago for self-settled trusts. The point is, we can present to the clients, you have risks of reciprocal trust, but if one spouse sets up a hybrid DAPT and the other spouse sets up a SPAT or even a DAPT, those are materially different structures, and that may alone, but obviously you would do more, break the reciprocal trust doctrine. You have the risk of divorce, but instead of doing plain vanilla SLATs where the spouse can't get access, that's the settlor, if you have a hybrid DAPT and a SPAT, both spouses are potentially beneficiaries. It gives you much more flexibility to deal with the outcome of a divorce. Third, in terms of access, if you have a SPAT and a hybrid DAPT, not just SLATs, and you create these trust and self-settled trust jurisdictions, you have much more access. So all the risks, I'm not saying are eliminated at all, but there's ways to mitigate them to some degree. We can't measure it. On the DAPT, hybrid DAPT, SPAT spectrum, it's also important to know that every year, new states have come on board enacting enabling legislation. Jonathan, it's over 20 states, I believe now, that have permit self-settled trust. Isn't that correct?
I believe it's somewhere in the neighborhood of 22. They vary depending upon the terms and so on. But yes, I think there are now like 20. Although choosing jurisdiction, you probably want to choose one which has no state income tax and permits very long-term trusts, because states do not permit long-term trusts. At least, for example, in Nevada, it says under their state constitution, perpetuities are not permitted, which could foreclose a perpetual or super long-term trust. Although I believe, Marty, that if you go out 100 years, the concept of mortality for intelligent beings will no longer exist. So maybe that's not true, but what you have to do is to be very careful in the drafting to make sure you're not violating, as the movie Body Kathleen Turner showed, if you violate the rule against perpetuities, you have no trust at all. Things go outright or it's void. So you've got to be very careful. So we have developed, and I'll just put this in legal, you can get it in order your trust, a certain cutback for the rule against perpetuities. In other words, it says, if this trust lasts long, then it will be cut back to basically lives and being plus 21 years. So that's a good safe harbor to have no matter what jurisdiction you're in, because it may be that you have some assets in a state where there is a limitation on the rule against perpetuities, as in Texas, but you won't have to worry about that because you have safe harbor language in there.
So let me summarize what we've just talked about, and then I'm going to ask Bob to start jumping into the proposal. There are new laws and lots of proposals all over the country for much harsher income and estate tax that may affect our clients. Some, like the Washington estate tax, has already been enacted. Others, proposals just like the one we're talking about now. But there's certainly, it is not uncommon, and it needs to be in the conversations we have with our clients, because we and our clients need to look long term. Second, we need to help guide clients and let them make the decision as to how to weigh the relative risks. In weighing the relative risks, the risks of divorce, lack of sufficient access, reciprocal trust, and let's throw in step transaction, because if clients wait to the end of whatever time period they have, step transaction becomes a much greater problem. Right now, I think we still have the luxury of time that we can slowly and methodically do things, because we don't believe that while Trump is in office, any of this can get enacted. But we should be starting, or at least letting our clients decide to start. So all the risks that exist have to be weighed against what seems to be almost a trend in many jurisdictions to increase estate tax, and proposals in Washington to increase wealth and estate tax. Whether or not the wealth taxes are constitutional is another issue. But we, I think, should be reframing the conversation to clients and letting them decide, hey, am I getting more nervous about these potential transfers? Should we not defer planning? And by the way, with the gift and estate tax exemption levels that Bob's going to explain in a second, this is not just for the clients that are at wealth levels for current planning. This brings it down to probably cover almost all the clients that all practitioners serve, because we're getting down to $1 million gift exemption. So I think, and this was a key point I felt we should make in this program, we may not need to do anything different other than, but at minimum, we'd be reframing a different question to clients, because they need to be mindful of this. So that was kind of a long-winded introduction, but I think that was one of the take-home points. Bob, why don't you start to explain, and I'll change the slides as you tell me, and Jonathan can certainly jump in, what this proposal is about.
Sure, Marty. Let's go through the heart of it, just quick snapshot. We'd increase the rate from 40 to 45%. So you'd have those rate changes. The gift tax exemption would fall back to $1 million. Now, back to the rates, the brackets are up here, 41%, 43, 45. Basically, then our gift tax exemption would fall to $1 million. I mean, we have become very complacent with the ability to move $15 million to the point where we're not as terrified on valuation issues as we would be if it was $1 million. If I have a client that hasn't used any of their exemption and we gift away a cottage or a business that we think is worth $2 million, we still have 13 million of exemption left. We're not terribly worried about value. If you get to $1 million, you could easily go over, and then you're looking at a 40 or 45% tax. Now, the estate tax exemption would cap at $3.5 million. And we don't know what would happen with inflation, but we'd have $3.5 million. That's the real thing. Now, the next.
Well, Bob, isn't it that there is no adjustment for inflation in the proposed bill by Senator Van Hollen?
Correct. I mean, there's no inflation adjustment at all. So just like anything else in the world of tax, that's $3.5 million is going to get smaller over time. Now, the other thing is portability would change. And this is what is so fascinating, is that portability, basically, Marty, would be capped at $1 million. So if I died, I could leave $3.5 million to a bypass trust. But effectively, I could only give my wife $1 million of my exemption. So if this happens, we're going to be funding bypass trusts much like we did in the 80s and 90s. I mean, now those will be our go-to planning ideas.
Bob, can I interject a couple of quick comments?
Of course.
So a common estate planning approach today, and for years, has been to create a marital trust, a Q-tip trust, in reliance on portability of a large exemption, whether it was, 5 million, whatever, 10 million, then now 15 million, whatever the number, but put assets in a Q-tip trust for lots of clients at not uberly high wealth levels, and even for many of them, so that on the second death, you get a basis step up, but you could port the exemption, now 15 million, from the first to die spouse to the second to die. That was a really effective plan. Many of those plans and the documents that have been and still are right now being drafted may not even include a family credit shelter or bypass trust, because you don't get the basis step up and we're relying on permanent portability. This law may change how we should be drafting starting today. At minimum, perhaps, and Jonathan, please comment, at minimum, maybe the default drafting approach, if you were going to do a Q-tip plan and rely on portability, is at minimum incorporate a credit shelter or bypass trust that can be disclaimed into, or use a Clayton mechanism, so that if the law in fact changes and DSU is capped, and I want to come back to that with you, Bob, because it's very confusing what they've done. But if DSU is capped at $1 million, you may want to fund $2.5 million to a credit shelter. Am I understanding that right, Jonathan? Should we be rethinking what we're doing to include that credit shelter trust and not just a pure Q-tip marital trust plan?
I think that's right, Marty.
And do I really give up that much? If I die, I fund a bypass for my wife, and I give her a formulaic contingent general power of appointment of the exemption she has left. She can still, if her exemption is 15 million in that bypass trust, if she doesn't have $15 million worth of assets, whatever extra she has will become a GPOA over on that bypass trust. So I think we can still build in flexibility respecting current law, but be ready for this, because this portability change is massive.
Bob, can I ask you a question about that?
Let me just make one point. That's one of the things you can do, is to grant the spouse a general power of appointment, or have the trustee grant the surviving spouse a general power of appointment to put it in the surviving spouse's estate for step-up purposes. But the alternative is just have the spouse have a special power of appointment, which can be and is exercised under the so-called Delaware tax trap under section 2041A3, which basically provides that if you exercise a special power and pay, that will cause it to be treated as a general power, even though it would not be subject to the power holders' credits, for example. And you would get it in the estate, and you'd get a stepped up basis. And one of that is you can pick and choose which assets are going to get the inclusion, and therefore you don't have to worry about including assets which have gone down in value rather than up in value.
Bob, I just want to make the point, we have a slide, we'll come to it in a few minutes. We have to try to discuss the ambiguities in this DSU provision, but I think the points you're making are really significant. This is really potentially an incredible retroactive tax change if the first spouse to die leaves a $15 million DSU, and it could be greater with inflation adjustments before this is enacted. And the surviving spouse can only use $1 million of that for gifting purposes. That is a huge change in the estate tax system that we need to be aware of.
Maybe I'm reading the bill wrong, but I think it's the million would also be at death, correct?
It appears so, but we're going to come to that. We have a slide on that, and it's obviously it's ambiguous. And certainly before they enact this, they'll probably clarify it. But based on what they've been doing and based on the Warren wealth tax proposal and all these other things that we were talking about, I'm sure they'll take the harsh interpretation of it. Quick comment, Bob, did you see anything? Because I did not, on GST tax. I think they just may have left it out, or maybe I misinterpreted it, but I would assume they would try to lower that as well.
The bill is silent on GST. Undoubtedly, once it gets to the technical drafters, they would shadow all these concepts for GST purposes, Marty.
Bob, you want to elaborate a little further on the DSU, and we'll talk about some of the ambiguity?
Sure. So
Let
basically,
me a
go ahead,
little
John.
in the audience. Basically says that if one spouse dies and to the he does not their full available estate tax exclusion, that the surviving spouse can inherit it. Now, you file a return in a certain way. There are now cases on that. You can have the spouse inherit the unused estate tax exemption of the first spouse to die. And that is a very major point in planning, but that will change here tremendously.
No, absolutely true. So we have this $1 million exemption. So the lesser of the DSU I give to my wife is the lesser of $1 million and the decedent's applicable exclusion amount minus what you used to already pay tax on. So basically, because it's the lesser of, Marty, let's say in 2030 I die, my wife would only get $1 million of my exemption. Now, here's what's not clear. I die today. You fill out a gift tax or a state tax return, you make sure my wife gets my $15 million exemption. So she's thinking she has my 15 million to sue. The way this is worded, and again, I defer to you guys to see what you think, but I read this a number of times. It is not clear whether somebody dying in 2023 or 4 or 5, and then the surviving spouse dying on the other side of this after it's passed. I think the person dying in 2030 after this became law would get a haircut, would lose that to sue from their prior spouse. And if that's true, and I'm sitting with somebody next week and they say, do I use to sue or do I disclaim and fund a bypass trust? That has to go into the equation.
And how can we possibly advise on that without a crystal ball? Because, oh my, let's say the client, the deceased spouse had $6 million in their name. You could fund a credit shelter trust. And I know people get very concerned about basis step up on the second death, but not to get into it because it's a different topic, but Jonathan and Bob mentioned using powers of appointment or the Delaware tax trap. You can also use asset location decisions, right? Maybe over time that becomes a trading account or it becomes the bond portion of the portfolio. So you can kind of use trading asset location decisions to cap the growth in it. But what Bob just said is a completely different framework. And I think what we need to do is include in our letters to our clients, hey, if you file an estate tax return, import the exemption, the surviving spouse gets 15 million. If you fund the credit shelter trust, there's no basis step up on the second death, which may or may not be able to be mitigated through these various techniques. But by the way, given this proposal, if you take what before this was the standard advice of put it in a marital trust or just take an outright marital and port the DSU, the exemption, you may now be capped at $1 million potentially, and that value of the exemption, if it's funded today, is lost. So Bob, what would you tell a client?
I would explain the bill, work with the surviving spouse and the family, and just let them decide what to do. Now, if we have time, we can build in the power of appointment to the bypass trust before someone dies. Arguably, maybe you could decant or reform to add that power of appointment afterwards, but I would be if I knew I was going to die tomorrow and I could update my estate plan, I would fund a bypass trust rather than relying on DSU.
So I think, again, one step that Jonathan and I talked about a few minutes ago is try to think about incorporating a credit shelter by trust that can be funded through a disclaimer or a Clayton Q-tip mechanism in estate plans that otherwise you may have just had a Q-tip trust. Secondly, change the letter that you send to a client before they do it to protect yourself. And if that's missed, and this is obviously premature because this is only after the fact if you didn't do the things we just talked about, 2519 disclaimers of Q-tips may be a bit more important to try to lock in exemption before it goes down. So that may be something else to just keep in the back of your mind. Bob, you would change perhaps the cover letter that you send, but let me ask you another question. So client comes to you and they're going to just file an estate tax return that's only for portability to port the $15 million exemption from their spouse that passed, and we all would try to advise them to do it. Is it worth filing that estate tax return to port an exemption if that dissue is going to be capped at $1 million? Don't we even need to point that out when we give advice to clients, which has been pretty routine advice? File the estate tax return, get that exemption, because now they spend the money to file an estate tax return. They're not getting a $15 million exemption. They're only getting $1 million potentially.
Right. Well, at 15 million, the benefit is $600,000 or $6 million, right? And $1 million, the benefit is 400,000. So there's still a good ratio of benefit when you file the return. Most simple portability returns are going to be $10,000, $15,000 at most. So it's a good ratio. And because we don't know what the law is, I would still be filing. But you're right. You wonder if you shouldn't point this out to someone just to be fair with them so they know what's going on.
Yeah, I think we need to add to our standard letter, hey, call file an estate tax return to port the exemption, but hey, by the way, just keep in mind, proposed legislation, if ever enacted, could cap that at $1 million, so the benefit may not be anything near what you think it might be. I think we have to change our letters in light of this, or we should consider doing that.
The three of us may have missed this, but to my knowledge, I talked about this, I didn't ask Jonathan, they've never proposed changing the portability retroactively like this. And so it's a new concept. It's a new, the wealth tax has been out there, changing the duration of GST trusts, increasing the rate, messing with GRATs and IDGTs, all that's been discussed. But this is a brand new concept. So we have to figure out how to work it into our discussions with clients.
Is there a chance, and I'm asking both of you, because I'm a little fuzzy, the cap on to sue is $1 million for, so if first spouse dies and there's a $15 million imported to the survivor can only use $1 million of that to make a gift. But does the 14 million that's left also disappear capped, or is the 14 million somehow then become available to the surviving spouse on their death for estate tax purposes? Are they intending the cap to for sure limit use on an estate tax return or just gift? I found the language a little fuzzy.
Well, I think it is fuzzy, Marty. I think you can use the full amount of it to sue on the second death. The lifetime gifts were limited, I think. But again, that should be clarified if the proposal goes through.
So that would, but what is that if I die today and my wife dies on the other side? Is she going to be, does she still get my 15, Jonathan, or does she get a 3.5 million exemption?
I don't think we know, Bob, for sure.
I think there's a couple of interpretations. her exemption after 2026 would be only 3.5 million, not inflation adjusted, because that's what this is proposing if it's enacted. For gift tax purposes, I believe she has $1 million of the 3.5 that she can use. I think for gift purposes, she is capped at $1 million of your dessous for gift purposes. And I'm not clear, but it seems that she may still get the remaining 14 million on her estate tax return plus her 3.5 million. I worry though that if it's ambiguous now and they actually gain enough control to enact something like this, they may very well cap all dessous for any purpose at $1 million, so that if the surviving spouse uses the $1 million dessous for a gift, there's 0 dessous, even though the portability amount had been 15 million, 0 left on her estate tax return. I don't believe that's what they've done yet, but you know, this is just, you know, the first salvo, if you will.
Well, keep in mind that Senator Van Hollen have been very smart in his proposal, because it's not just let's increase the tax rate on wealthy people. It's in order to fund Social Security, because the rumor has it that within 3 years, Social Security is going to be busted. There just won't be sufficient amount in the Social Security Trust Fund to continue to provide benefits. So this, again, is part of the Social Security change. So people who may otherwise be opposed to an increase in estate taxes might say, well, I've got to have some from my old age. I'm not opposed to them enacting this particular statute.
I think the point you just made, Jonathan, is one of the most important points about this proposal. And I agree with you. He was very clever in how he wove this together. We're not looking to tax the wealthy to cap wealth disparity or fund social programs generally. We're using this to keep Social Security solvent. Is there anyone in Congress, anyone, that can go to their district and say, hey, by the way, Social Security is going to be bankrupt in a week and your payments are going to stop? There's nobody that could face that. And I think what you said is critically important, because even if practitioners want to and clients want to dismiss this, can't happen. The government cannot allow Social Security to dry up. It can't be politically palatable. So if this gives a way of keeping Social Security afloat, that may well be sufficient to get people with all different types of views and all different political persuasions and all different types of views on the tax system to go along with it. What else are they going to do to keep Social Security afloat? It cannot be allowed to lapse.
That's the 64. How are you going to, I mean, well, remember, George W. Bush proposed an elimination of basically Social Security by saying we're going to give you tax breaks so you could save on your own. That was not well received. It never went through, and I can't imagine it going through in the future, because the problem right now is just there is not enough money in the system, enough tax money to be able to fund Social Security for the foreseeable future. And that has to happen. That would be political suicide for a politician to say, well, Social Security disappeared, that's okay.
I think that was the brilliance of the proposal in terms of trying to get it a better shot at getting enacted. So if you don't agree with these harsh estate tax proposals, tell me something else we can do to fund Social Security, because we cannot allow it to lapse. And we may very well see surprising things because it cannot lapse. Bob, what are some of the strategies? What are some of the things that practitioners want to start talking to clients about because of this?
Well, I think the interesting thing will be, we have many clients where we've done estate tax returns for to give the 15 million or 13,990, whatever it was at the time, to the surviving spouse. And, you know, I think the way you guys read this language, is it fair to say that there's a pretty good chance that the surviving spouse exemption to sue wouldn't be 15, but would be 3.5?
I'm not clear on what they've done with that. Clearly, it's 1 million for gift.
It's
What
clearly
happens to the excess if there was a $15 million ported exemption? What happens to the 14? Do they get up to 3.5 on a state, 2.5 because they used one, or do they get the remaining 14? I'm not sure. I'm not sure.
You know, what I'm tempted to do is for people with high basis property, especially spouses that are, let's say, over 80 years old, I'm tempted to try to give away that 15 million. Because remember, dissue would come first. So husband died, wife survived, wife could give away 15 million. It will come out of her dissue first from her husband. So, and she'd still be left with her exemption. And you need to do a lot of financial planning to answer the question, how much does a surviving spouse need to live on? Once you know that, you can determine your gifting. You can safely determine your gifting. Now, what you want to, the problem is there's a lot of people, Marty, with NVIDIA and Meta and Apple with a basis of $1, fair market value of $200 or $300 a share. And they are holding on for that step up in basis. And that's the fine line we have to walk.
Jonathan, isn't the dynamic a little different? So for example, if I have an estate of $20 million, why would I wait until the gift exemption is reduced to $1 million? Why don't I gift as much as we can possibly feel we can safely do to a hybrid DAPT, and my wife gift as much as we can safely do to a SPAT? So between her being a beneficiary of my trust, me being a beneficiary of her trust, she's you know, subject to a special power of appointment under her, the trust she creates, and I can be added back as a beneficiary. So we have multiple access points, plus we could put in a loan provision and a tax reimbursement provision. We put these trusts in, say, Nevada and Alaska, where self-settled trusts are permissible, and we feel more comfortable with the SPAT and hybrid DAPT in those jurisdictions. Let's say it cost 15 grand to trust and 4 or 5 grand a year to maintain those trusts. It seems that the cost of creating a trust structure that has significant access, gives me a good argument, is out of my estate. Doesn't that sort of change the analysis of what the client is weighing? Golly, do I take a risk and see that Social Security could be on the edge of bankruptcy and they're going to have to do something and it could be this? Or do I fund hybrid DAPT and a SPAT sort of as a spousal, as a SLAT-like plan today for the cost that's involved, which is negligible compared to the potential transfer tax cost? Why not do the planning today? And gee golly, I get some great asset protection. Thoughts?
Well, I would personally agree with that, Marty. I mean, we just have to balance the basis against the estate tax savings. And that's, a lot of this is just math. But if you're going to lose your dissue there, you don't need to run the math. Then that becomes easy.
Right, but we don't know how to quantify it. So if we did like a decision tree with different, you know, probability nodes, we don't know how to estimate the probability of any of this getting enacted. But Jonathan's point a few minutes ago that Social Security is tied to this because it's got to be funded. What other proposals are there out there that's going to help fund Social Security? It cannot be allowed to lapse. So something's going to happen. Why not make these moves now? Especially if we can address the divorce and reciprocal trust doctrine in the manner we discussed, not perfectly, not wholly, but to a degree. And especially if we can address the access with the approach that we've just talked about, that seems to be a different dynamic to planning.
Totally agreed. So, but we should have a window. Here's what everybody has to be ready for. You have to have a list of people that you helped with the suit. And then this bill, if it were to be passed tomorrow, just pretend, it wouldn't be effective to January 1st, 2027, December 31st, 26. So right now we would have a good 7-8 months to react and make gifts of that $15 million that may have already been transferred.
Let's talk about that for a second, because it's an interesting point, and I think it's important. I would rather a client come in and have one spouse set up the trust they need today. They could put in $1,000, $10,000, $20,000, something to get the trust going. And we could even prepare transfer documentation for an LLC or whatever they're going to put into it. At least we have the planning done. We have one trust done, and the date of that trust is now different. And if they have to quick create the second trust later and fund the first trust, they're way ahead of the curve. See, I think this becomes the same kind of problem we had in 2020 and 2021, where the legislation was proposed that could have been retroactive, and oh my, if we didn't get the planning done ASAP, that it may not be even possible to be effective. So clients came in, as they always do, at the very last minute, and step transaction doctrines, reciprocal trust doctrines, all become much more problematic under a compressed time frame. I think the prudent client should evaluate, if I have to pay to get a trust created today and pay a trustee in a trust-friendly jurisdiction, Michigan, Tennessee, New Hampshire, Delaware, wherever, South Dakota, X dollars a year, maybe this is worth doing. I get good asset protection anyhow, and I have lots of access, and I've reduced the other tax risks. But boy, doesn't it seem inevitable that something has to happen with the tax system to support the Social Security system? And I think that was the linkage that he created in this proposal, which, honestly, I think is a very clever way to try to get some of the social engineering he wants done anyhow, but it's done for the purpose of keeping Social Security afloat.
There's only 4 choices: higher income tax rates, decap the Social Security limitation. Right now, you only pay Social Security tax on $150,000, $200,000 of your income. Decap that, go with some type of wealth tax, or go with a change in the estate tax. I mean, those are the only 4 arrows in your quiver.
I would anticipate, I'm not going to comment about the wealth tax because there's constitutional issues. It's never been done, and that may just be floated as something to, try to keep the game going, but or for negotiations. But they may do all 3 of those, Bob. We could have the 150 go up to 250. We could have lower estate tax exemptions and funnel the funds into the Social Security pot, just like this is proposing. And we could see higher income taxes as well. I mean, they could do all of the above. They may have no choice. Social Security cannot stop making payments. There are far too many people dependent for their survival, literally, on those payments. So let's change gears a little. Bob, one of the things that this does, and we haven't had this for a while, is now we have a different gift exemption from an estate exemption. How does that affect planning other than making it more complicated?
Well, what I've noticed in the last 36 months is that many families we represent can simply make a gift with no GRAT. GRATs have hardly been used at all in the last 2 or 3 years. We'll come back to that in a second. But most people are just making a large gift into a slat, and that suffices. Now, for people at the next level of wealth, the go-to has been the IDGT sale, primarily because the IDGT sale is a multi-generational technique, 3, 4, or 5 generations, Marty, in perpetuity if we go to the right state. Now, the GRAT is only a 1-generation technique from you to your children, Marty. And so it's not as attractive as the IDGT. So, but basically what we're going to see, if we can only give away $1 million and the GRAT and the IDGT survive, those will become the go-to techniques again, mathematically.
Oh, I do, because if you have $1 million exemption and a client's worth $10-20 million, and again, $10 million clients have not been planning for years now to the extent that this bill would make them plan. Even $5 million clients may want to start thinking about planning, because think of the growth on a $5 million estate. Think about what the $1 million cap on gifts does. You can only get $1 million growing out of your estate, and if you have a business interest, that could grow significantly, even a stock portfolio growing over time, and the $3.5 million is not inflation adjusted. The forecasting with no inflation adjustment on the 3.5, the $1 million being all you can get out unless you use leveraging techniques, people should act before, and if not, what they're going to end up having to do, like we just said, is note sales, GRATs, techniques that don't use exemption, because they won't have, with a $1 million cap on it, much exemption to use.
But I think we're naive if we think that this bill would stand alone and works its way through Congress. People won't go back and find the other bills that did three things: stop digits,
Yep.
stopped GRATs. Remember, we had a 10% rule with GRATs, and then had dynasty trusts only go 2 generations. See, one of the beauties of the dynasty trusts that are being created today is they can go for 3, 4, or 5 generations longer. Under the Biden and Obama administrations, you would have been limited, Jonathan, I don't know if you remember precisely, but I think 2 generations. So, that's not that much time.
Bob, I think you're 1,000% right. If the Democrats get the clout in Washington, they will dust off all the old Bernie Sanders, Elizabeth Warren, Van Hollen, all these proposals and consider them. But again, I think what is different, clever, and strategic about what he's done here is he's tied it to the survival of Social Security, which I don't think anybody can vote against unless they have another alternative to fund it. Jonathan, there's another drafting consideration that I think is different. We previously talked about how if you're doing a one lung Q-tip, I think some people call it a Q-tip trust, to use portability and get a basis step up, I would change that default to include a disclaimer credit shelter or a Clayton Q-tip, because that, if something like this is enacted, may become much more important to do. Another default, a lot of the irrevocable trusts created now have not included crummy powers, because you don't need the complexity. You don't need annual gifts. You don't need to send out crummy notices. And lots of clients, even trustees, don't follow up on the crummy notices, so there's always issues there. And if there's just family business or real estate holdings, it's not clear that it automatically qualifies as a gift of a present interest. So many of the irrevocable trusts, to simplify matters, have not included crummy powers, annual exclusion mechanisms. That maybe should change too, because if we end up with $1 million gift exemption and you have an irrevocable trust, you don't want to have to create a new one that has crummy powers. Maybe we should be by default making that part of the standard plan now, even if it hadn't been what somebody was doing before. Thoughts, comments, either of you?
Well, if we're at $1 million exemption for gift tax purposes, the crummy powers are going to become so important.
Critically.
And I can remember distinctly in the early 1990s, I represented this lady she eventually made it to over 100, but she had 7 children and they all had many children, and she was writing out close to 100 checks a year. I think they were $3,000 checks at the time.
Yeah. This is another indication of how planning will change, but it doesn't take much cost, time, or effort to build in a disclaimer credit shelter or a Clayton Q-tip, to build into irrevocable trusts, broad crummy powers. And maybe that's what we should just be doing, just because of this shot over the bow. Even if we're confident it's not going to be enacted, we can build that type of flexibility into our planning documents, just to keep our clients maybe having a better chance at getting able to do it. We've already talked about GST. We're not sure but I would guess that they're going to cap it at $1 million for gift purposes and probably 3.5 for estate, but you never know. But again, planning before something like this becomes law is really important. Bob, we've kind of covered it, but maybe just run down some planning steps people might want to think of, or at least suggest to their clients.
Yeah, the first thing is explain to people what the law is right now and show them, maybe talk a little bit about towards the end of the Trump administration, they should come back into your office and meet again, because we're going to have a better direction after this midterm election, and certainly after November of what would be 2028. Then we'll better understand where we are. And I like your idea of maybe we put together a trust right now, like my wife and I, we put together a trust. Even if we don't fund it, Marty, it's like a house you could move into in 10 minutes. You know,
Right.
it's just, you don't have to deal with drafting the trust, working with the trust company in Nevada or Alaska. You don't have to deal with getting an EIN number. I mean, all that stuff is done. And then all you have to do is do an absolute assignment of the property, and you can put it in there probably easily within 2 weeks. So that may be the thing to do.
I think where you have clients that are worth even $10 million, maybe even less, right? At a $10 million net worth with a $3.5 million exemption, you have over $1 million of estate tax. And that's not even addressing what may happen at a state level. So to spend the money today to get a trust set up so that you have, you know, you're in the on deck circle to pull the trigger, certainly makes to me a lot of sense. And I would go a step further that for asset protection purposes, with these kind of you know, winds out there blowing of these proposals all over the country in terms of local plus on the federal level, why not just fund a SLAT that's really a hybrid DAPT or a SPAT today? So you have the asset protection, you got the growth out of your estate, but you have lots of ways to get at it. And through those accessible mechanisms of the SPAT or hybrid DAPT, and yes, there are estate tax risks with it, but we just had a case in Delaware uphold a DAPT, a hybrid DAPT has to be safer. And that case in Delaware is not exactly pristine trust administration. If the clients administer it properly, there may be a reasonable chance, a likelihood of a hybrid DAPT and a SPAT succeeding. But why wait? I think waiting is not the right option. And the cost of setting up these structures is not that significant. The flexibility that we have as draftspeople today compared to 10 or 15 years ago, or what we did in 2012, is significantly greater. Why not do it? What happens, Bob, after 2027? Let's say all this stuff gets, I don't think it will, but we've kind of talked about it, but planning changes.
Planning changes, and the simple fact is what we're seeing right now is the young CPAs and the many of the young CPAs, many of the young lawyers just haven't been exposed to this. You have to remember, most of the people our age grew up with a $600,000 exemption. So in 1995, people understood all these techniques because they were needed. Virtually everybody had to understand them. We've lost a little bit of our step because the exemption has been so high.
That's a very interesting point. Educating the younger professionals that have not worked with this, because it's only a high wealth client, and is very, very important. I would add to what we have on this slide, what we had talked about: disclaimer credit shelter trusts being built in, crummy powers into irrevocable trusts. You know, we're going to go back, Bob, perhaps to more use of entities for discounts, which at a $10 or $20 million estate level may not have been even thought about for years, but now becomes relevant again. Yeah, we're going back to a lot of the prior planning that we used to do. But again, look at what and you said this earlier, Bob, with people just making a cash gift. If right now a client has a $15 million exemption and they set up a hybrid DAPT in Delaware, and they want to give $6 million to it, they just give the $6 million. If this law gets enacted at some point in the future, and it may, and the exemption's $1 million, you now have to jump through hoops. Think of the cost and complexity of trying to make the same plan. Today, I can just have a $6 million gift written to Delaware hybrid DAPT. But after something like this is enacted, I'm going to have to set up an LLC. I'm going to have to hire an appraiser. I'm going to have to get discounts, which heightens the audit risk. I'm going to have to put some in a GRAT, maybe use a note sale for some and just a down payment with a different asset perhaps to the same. Look at the cost and complexity and tax risk of doing this after versus doing it before.
I think those are all good points. I think we just have to see what happens in the next 6 months and be prepared to react to it, Marty.
Bob, would you give somebody different advice about portability versus the credit shelter? We've talked about it, but maybe just summarize the points.
If I knew I was going to die tomorrow, I would make sure my bypass trust was fully funded.
It sounds like a safer approach, and if you can build in a power, that sounds good. We've talked about the Social Security tie-in. There's a number of issues in this. There's no inflation adjustment. We're not clear. It doesn't seem to address GST, but we assume it will. There's some fuzziness about what happens to the DSU. It could be just for gift, it's capped at $1 million. It could be overall $1 million cap. It could be you get another up to $3.5 million total, or only 2.5 because the one counts. It could be you get the full only, if you used one gift. I'm sure all that'll be clarified. I think we need to change how we communicate, or some of our communications to clients, put the burden on the client or the opportunity to make a decision what they feel comfortable doing. We can't assess any of this risk, just like we can't assess the risk of divorce or the risk of reciprocal trust doctrine. All we can do is advise and let the clients make decisions. It's not law. We don't know what will get enacted. I think Jonathan's comments about the tie into Social Security is really part of the strategic and clever approach being used here. And if the government doesn't come up with a different way to enact Social Security, it's got to happen. Bob, the failure to fund TSA has people struggling to make ends meet because they're not getting a paycheck. Can you imagine what that would be if Social Security missed checks for a month or two?
We can't do it. Many people, the statistics are many people, their primary source of income is that Social Security check.
People would starve. It cannot happen. So for those in all the allied professions that want to dismiss this, what is the other alternative being proposed, or alternatives to fund Social Security? So, Bob, do you want to make any last comments?
No, just think about this. Be very careful with people where husband dies today and you're recommending to the spouse not to disclaim but to use to sue. Determine whether there's a more balanced approach.
Thank you for joining us. We'll all stay tuned to see what happens, but our never changing world of estate planning. I think one of the key bottom line lessons of this, there is no certainty with anything we do. And that is something we should all think about communicating to our clients, because we can make what sounds like today a really prudent decision in terms of advice given to a client, and then they change the rules in Washington. These changes, as Bob pointed out, are really dramatic. And if something like this went through, it could make advice that we've been giving confidently for years wrong. So keep all that in mind. Wishing you all good luck, and thank you again for joining us.
Thanks, Jonathan. Thanks.